Hi everyone, I'm Lee. Welcome to my channel. Project 120 is a challenge I put to myself to make $120,000 in a year on top of salary by various means. Trading investing is one of them. I'll be showcasing two of my trading accounts for 12 months or in 52 updates. We'll see how we do. Let's delve right into it. This is the screenshot from the previous week on Tiger Trading account. The market value was $14,860. Fast forward to this week, the market value is $16,430. I continue to reduce or close my positions. I sold the 10 call contracts on Baidu when there was still profit. I had hoped that the earning report would boost the share price, but the way I look at it, the share price will just go up and down between 100 to 110 Hong Kong dollars, and I don't have the time to wait for it to go up, as my options are expiring in 5 weeks. I also closed the position on Tencent. As I mentioned, that would be my first choice, and I went with that. I'll probably get in again when there is a dip in Tencent's share price, or there is a clear upward trend. Remember, the share price for Tencent has already gone up by 36% this year. Not that it doesn't have the potential to go up more, but I doubt it will be in a linear fashion, which means there will be ups and downs. Just a few more words about Alibaba. I've been following the stock for more than 4 years now. This company took the most hit during the Chinese government's tech crackdown back in 2020. Its market cap dropped about 75% from its peak of more than $800 billion to $210 billion now. I did a quick check today. When it went public back in 2014, the market cap was $220 billion. How come it's worth less than what it was 10 years ago? All of these have to do with the idea of valuation. Valuation of a stock is the process of trying to put a price tag on the worth of a company or its stock using mathematical models. There are two main camps. One is called the relative valuation approach, and the other absolute valuation approach. Each approach entails numerous valuation models. The relative valuation approach is largely predicated on the law of one price, which states that similar assets should be valued at similar prices. Based on that principle, all we need to do is to compare the key multiples of a stock to that of a benchmark stock. Amongst the price multiples shown here, price-to-earning ratio is the most commonly used. Absolute valuation approach aims to determine the intrinsic value of a business by looking at its fundamental aspects, such as dividends, cash flow, growth rate, and etc. The two popular models are dividend discount model and discounted cash flow model. Of course, the key here is the company being evaluated needs to have either stable dividend or somewhat predictable positive cash flows. For those who wonder why the models are named as such and both have the word discounted, this brings up another core financial concept, and that is time value of money. What it means is that $100 today is worth more than $100 1 year later. I suspect many people already know this, but how to explain it? First of all, opportunity cost. If you have $100 today, you can invest it and potentially turn it into X amount of dollars depending on your expected return. Secondly, we all know that inflation is always there. Price goes up over time and you can't buy the same thing for the same price forever. In other words, inflation erodes the value of money. Therefore, when you look at a dividend or cash flow that shareholders receive in the future, they will need to be discounted. The big problem here is that what kind of rate do you use? In those mathematical models, regardless whether only one rate or multiple rates are used, people invariably have to make assumptions about future interest rate, company's dividend rate, growth rate, calculated risk premium, so on and so forth, which make the result a good guess at best. Coming back to Alibaba, when the company was growing at 40%, 50% per annum, the models valued the company using very optimistic rates, resulting in a high valuation. And when it slows down, again, miserable rates are used, and the value of the company suffers. Personally, I think it's important that you have a baseline valuation that you subscribe to, that you are comfortable with. And from there, derive the best case and worst case scenarios so that you have a feel of whether the current price is reasonable to you. To me, the fair value of Alibaba is around 150 Hong Kong dollars, and I will always try to get in a long position with Alibaba whenever the market seems to turn in its favor. Moving on to the other account, Moomoo Singapore. This is the screenshot from the previous week. The market value was 13,700. Fast forward to this week, the market value drops to 12,000 now. I mentioned that I made some profit from Tesla put options, and I was still holding just one Tesla put option. Well, I made a decision to increase my short position on Tesla last week, and I'm now holding 5 Tesla put options. As the share price goes up, I'm now making a loss of 1,700. However, I've switched from doing multiple trades intraday to a similar approach I take with Hong Kong market. So my options expire 1.5 months later now, and I have a bit more time to decide what to do. Some of you might be wondering why I seem a bit persistent with shorting Tesla. Well, if you look at the share price 3 years ago, it was trading around $200 if you normalize the price considering the split. 3 years later, it's still trading around $200 or slightly less. And in between, it went as high as $400 and then it dropped to 110. Then it went back to 270, and now it's on a downward trend again. I think there are 2 reasons for the drastic price fluctuation. The first was the macroeconomic condition in the US, i.e. the speculation on the pace and the extent of Fed's interest rate hike. During that period, there were people predicting the rising interest rate would result in a hard landing of US economy. The market was volatile, but in the end, the so-called hard landing didn't happen yet. And on the contrary, the big techs, including Tesla, were performing much better than expected in terms of both growth and profitability. When Fed practically announced the end of interest rate hikes, the market rallied like it's some sort of punishment on the shorts. But does the earning of the market as a whole justify the current price? Personally, I'm quite skeptical. The second is that Tesla as a company is largely dependent on how the market position it, or should I say categorize it, which in turn depends on how Elon Musk continues to sell new stories while trying to catch up on the old ones. What I mean by that is Tesla is definitely enjoying a technology company's valuation instead of a car company's. Its PE ratio is even higher than Apple's, Facebook, and Google. I have no intention of debating whether it's really a tech company or a car company which has technological advantages over other car companies, because the debate is already out there and there's no conclusion. But the point I'm making is that it's awfully hard to maintain the hype now that the market has a new favorite, which is generative AI. While Tesla's Model S Plaid and Cybertruck have had their limelight a couple of years ago, both its sales and production have been dipping. Not to mention there is a trend of reversing the electrification of cars led by the US, largely for political reasons. Is Tesla going to rise again? Probably yes, in a few years. But in the short run, I wish to profit from its downturn, if there is one, and hopefully catch its rise in the long run. Generally speaking, I want to long Hong Kong market for its cheap valuation and the beneficial policies towards the capital market as a whole, and short the US market for the perceived high valuation and AI bubble. I could be wrong, as I often am. What do you think? Comment down below. Again, thank you so much for watching. Until next time.